The best traders in the world lose more trades than they win, and they still walk away profitable. If that sounds wrong, this video is for you. Because the thing that separates profitable traders from everyone else isn't how often they're right. It's how they manage risk. Most beginners think trading success comes from one place, picking the right entry. Nail the pattern, nail the timing, and the profit takes care of itself. But traders who have been at this a while know that story is incomplete. Picture two traders. Both pick winners 60% of the time, the same edge. Trader A risks 10% of her account on every trade. Trader B risks 1%. Then a losing streak hits, a bad week every trader eventually has. Trader A's account is gutted, Trader B barely notices. Same edge, same entries, only one of them is still trading. So if entries aren't the answer, what is? Every trade is a bet with two numbers: how often you win and how much you win when you do. There's a simple piece of math that ties the two together. It's called expected value. Picture a setup where you win half the time, a coin flip. When you lose $1. When you win, you make $2. Half the time you lose $1, half the time you make $2. Average that and every flip is worth 50 cents. You just made money on a coin flip because your winners were worth more than your losers. Now flip that idea around. You can be wrong 60% of the time if the 40% you get right pay you enough. The math does not care how often you are right. It cares about the size of each outcome relative to its probability. There is a second number that matters more than beginners realize. Not how much you make when you win, how much you lose when you lose. Because coming back from a loss is harder than most people expect. Lose 20% of your account, and you need a 25% gain just to recover. Lose 50% and you need 100%. Lose 80% and you need 400%. Look at that last one, you would have to quintuple what is left just to get back to where you started. That is why big losses do not just hurt, they compound. The trader who avoids the deep drawdown is not just preserving capital. She is preserving the compounding power of every good trade that comes after. Which brings us to a number you will see everywhere in trading. Risk no more than 1% of your account on any single trade. Why 1% specifically? Because it is the number that survives a losing streak. 20 losses in a row, which almost nobody hits, leaves you with about 82% of your account. At 10% per trade, the same streak leaves you with about 12%. The math flips on you fast. 1% is the floor, not the ceiling. More experienced traders tune it, but they tune it from a position of strength after they have already proven they can survive. So here is the frame. Risk management is first, edge is second, entry is third. You can be wrong more than half the time and still profit, if you size right and the math of your setup is positive. You can pick brilliant entries and still blow up if you don't. In the next video, we'll turn the 1% rule into a practical calculation. How to size a position given your entry, your stop, and your account. This is educational content and is not a recommendation to buy or sell any security.